Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned in to On Trend, the show designed to keep you on the right side of the trend. It is Thursday, January 17th, so we've got the 50-day SMAs coming into play as breath wanes. We'll dissect the rising wedge. We'll also look at the resetting of key levels for the big sectors. We'll show that retail, housing, and semis are starting to weaken. We'll cover the intermarket arena, and I will finish with some stocks to watch. Breath is starting to wane as some key indexes hit their 50-day moving averages. So we're going to start off with a chart that shows the four major indexes as far as I'm concerned. The S&P 500 in the top window there, the S&P Mid Cap 400, the S&P Small Cap 600, and the NASDAQ 100. And keep in mind that I think all of the NASDAQ 100 stocks are also part of the S&P 500. Now, the first thing we can see on this chart is that all of them are below their 200-day moving averages, which are the red lines. So we had a move to new lows in all of them in December there, and we've gotten this big bounce. The bounce heard round the world. All right, but here we are, we're hitting the 50-day moving averages for the S&P 500, for the S&P Mid Cap 400, just above it. We're just below it for the S&P Small Cap 600, and we're just above it for the NASDAQ 100 there. So, this is the first battleground, if you will. And, I don't view the 50-day as like a key resistance level. All right. But for the S&P 500, I think that so many people watch the 50-day and the 200-day and the S&P 500 that it almost becomes a self-fulfilling prophecy. So when you get up to that 50-day, you might get some selling pressure and we might get a pullback here after this advance. But I think the most important takeaway here is that we're well below the 200-day and the 50 days are below the 200 days. So, we have long-term downtrends in all four of these indexes. And by the way, if you're looking and you can't quite tell 50-day or prices above or below the 50-day, if you go over to the left of the chart, there you can see the actual values. So the small cap index is at 906.84, and you can see the 50-day is just above it at 908.26. So this chart here shows the S&P 500 there in the top window. And then we've got the AD% indicators for the S&P 1500, the S&P 500, and then further below the S&P 400 and S&P 600. And we've had a surge. That was December 26th when we got the big surge. And then we had another surge at the beginning of the year. And then we moved higher for around 7 days. But after that New Year surge, if you will, you can see that breath has been waning. It's not been as strong. That's S&P 1500 breath. Didn't get above 50% AD%. So participation is narrowing as this advance extends. And you can see for the S&P 500 as well, participation is narrowing. And if we scroll down, we can see that we had a better day for the S&P 600 small cap. It almost got to 50%, but not above 50%. Mid caps didn't get above 50%. And look at the S&P 500, 18%. So large caps were clearly not participating in that little gain that we had yesterday. If we scroll further down here, we can see that new highs are still failing to impress here. All right, this chart I've shown before, and you can see here that we basically had one new high in the S&P 500, 4 in the S&P Mid Cap 400, 6 in the S&P Small Cap 600. So 1% basically of those 600 stocks hit new highs. And so we have 11 new highs after this big advance, and that's just not enough to suggest that we're in a bull market. And then finally, short-term, we're overbought. I'll show some short-term charts next, but this is the percentage of stocks above the 20-day moving average here for those four indexes. And we can see it's been above 70% for 1, 2, 3, 4, 5, 6, 7 days. So as long as we're above 70%, okay, we can stay overbought. It's like that rising wedge. It's rising until it isn't, which we'll get to next. But if we get moves below 70%, that would be a bearish signal for this indicator and suggest that we're turning back down. So a lot of us, of course, are seeing the rising wedge out there, but there's three things to keep in mind with a rising wedge. First, it is potentially bearish. The second is it's potentially a counter trend bounce within a bigger downtrend. And third, and most importantly, it is an uptrend as long as the wedge is rising. And so that's why we need to look for some sort of downside catalyst to suggest a reversal of this short-term uptrend. So here is SPY, and I haven't drawn the wedge here because I'm going to show it next on the 30-minute chart. But, we've got the same thing in force here. Support here is broken, and it's turning into resistance. And we have those 50 to 62% retracements there. We're in that zone right now. RSI is at the peak of what could be a momentum top, and 5-day RSI is overbought. So this is an ideal spot for a reversal, but often the ideal doesn't always work. So we have to watch closely this rising wedge. And so what I've done is I've drawn the trend lines here, and you can see this one is sloping less steep than the lower trend line. And what that's implying is that the highs are getting less momentum is behind the rising highs here than there is among the rising lows. So upside momentum is waning. That's the theory behind the wedge here. But within that wedge, we had that, consolidation there and the breakout. And that breakout is bullish until proven otherwise. And so what I've done here is I've raised support to fit these lows here. And so that's the key level to watch. And if we break support here, that is going to reverse the rise in the rising wedge and be a bearish development for SPY and the broader market. If we look at QQQ, we can see a similar pattern unfolding as far as, the 62% retracement is right there. We're just above it. So it's done a little overshoot. There is broken support turning into potential resistance, but we're above it. I'm not calling that a breakout because, this is a hard resistance level, a prior high. So, a move above this prior high would be a breakout, but this is just a move back into the consolidation right now. And then if we look at the wedge in QQQ, the lower trend line is not as steep, and that is because you had this pretty sharp dip here on the 3rd of January. But it matches up with the support level based on these lows here from last week. And so if we break down below here, that's going to reverse the upswing in QQQ. But right now in both QQQ and SPY, this little breakout here is the dominant signal. And, you need to get back below 160 to negate that breakout there that we saw on Tuesday. And if you go back up to SPY, you would have to get below, say, 259 to negate that breakout. All right, and just briefly, there is MDY in a similar situation as SPY, hitting broken support, turning into resistance, that 61.8% retracement, and RSI in the 50 to 60 zone, and 5-day RSI overbought. Then we look at IJR, a similar situation. This is small caps. And then here is IWM, the Russell 2000 small cap ETF. And this is not a rising wedge, but I don't really care if it's a rising wedge or a rising channel. I think the main point for me is this was a decline in the direction of the primary trend. This is an advance that is going counter to what I think is the bigger trend. I think the bigger trend is down. And so the same levels really apply. You can see these recent lows marking support. And if we break those, that's going to be a bearish development for IWM. And you can see that its breakout, I don't think, was as strong as the breakout we saw elsewhere. So small caps, the last 2 days are lagging a little bit. So with the short-term breakouts we had over the last couple of days, we need to reset the support levels for the key sectors going forward. So now I'm going to break down the S&P 500 into the 11 sector SPDRs. And quite frankly, you really only need to look at the top 6. All right, the top 6 that I'm going to show you account for 78% of the S&P 500 or SPY. And there you can see XLK accounts for 19.9%. We'll just call it 20%. So that means the other 5 sectors account for 22%. The next biggest ones after these 6 would be energy and consumer staples. So if we look at these top 6, we can see, that all are below the 200-day except for XLV. XLV just moved above its 200-day, but it's got a rising wedge working. But XLK is still well below that 200-day there. And we can see that if we break the wedge support, I just put support here, no sense putting it at that trend line, but if we break support there, that's going to be negative. So as long as all of these hold their support levels, no hay problema, all right? But once we start breaking down, then we have issues. Here's XLF, which has been leading over the last 2 weeks maybe, but it's still lagging. I mean, look how far below its 200-day moving average it is. And a breakout really doesn't happen until we get above these November, December highs. So, I'll watch support here for XLF. Then we get to XLY, which is battling its 200-day right now. And these last 3 account for around 10% each of the S&P 500. All right, so if we break there, that's bearish. XLC is stalling and XLI is stalling. So we've got some key support levels to watch. And when the majority of these, say 4 of the 6, break support, or if they break support, then we have a downturn to bet on in the market. But as long as the majority holds support, we could continue trading range or moving higher. So if we look at XLY here on a 30-minute chart, and the only reason I'm looking at 30-minute charts is because I think this current rally and these current support levels are quite important. Normally I look at daily charts. That's my bread and butter chart, basically. But I think the granular look here, going into more detail with a 30-minute chart, makes sense when you're focusing on the advance of the last 15 days and looking for clues that it might reverse. So when we look at XLY here, it didn't really break out. It did, but it fell back into its trading range. So it's lagging a little bit. And if it breaks support there, that would be negative. We look at XLK. Again, that lower trend line, you can see because of this depth of that low there on the 3rd, it's not as steep, but clearly you got a support level to watch there. The breakout is holding, but if you move below 63.5, okay, you get concerned. If you move below 62.5, that's going to be a bearish development for XLK. And again, I wouldn't consider a short-term bearish development important except for the fact that the longer-term trend is down. All right, here's XLC, which is one of the leaders over the last 15 days. There you can see the breakout, which is bullish and holding. And there's the breakout zone, first level to watch. And then there's the support level at 43.5 to watch. We look at XLF. Its support level is quite a ways away. So it's not in danger of giving up its breakout or support level right now. We look at XLI, and it's lagged over the last few days. You can see that it doesn't have a breakout there working, and watch support there at 67. Look at XLB. It is also lagging over the last few days, but XLB accounts for like 3% of the S&P 500, so it's not going to make or break the index. But, it did break that support level already, has a lower high working, so it's already looking negative. We look at XLE. It's been going nowhere while the market has been rising, all right? And that's just underperformance right there. And if it breaks support, that would be a negative. We look at healthcare. We can see that rising wedge there. And if we break support here, then that is going to be a bearish development. So these are some really key levels to watch here. XLP at 51. And you can see it tried to break out, but didn't really get above that breakout zone. So if it breaks down, that's bearish. And moving on to the last two, utilities. Yeah, I'm not sure what to make of utilities, but I'm wondering if bonds turn around, that could benefit some of these interest rate sensitive groups. So I'm not sure what to make of utilities other than that, maybe a breakout there at 53 would be bullish for this group. And then REITs are performing very well, continuing to move higher over the last few weeks. So that's another interest rate sensitive group that's moving higher. Retail, housing, and semis are starting to weaken. So I created a chart list with the industry group ETFs that I like to follow. Your groups may be different, but what I did was, in each name here, I prefixed it with a number, and so that ensures the sort. So at the top, I've got my consumer discretionary industry groups, and then I've got my technology industry group ETFs, and so on. And there's 50 or so ETFs here. But what's nice, if you create a chart list, then you can do different things with it as far as viewing is concerned and analysis is concerned. For instance, I could click Candle Glance, and I would get Candle Glance charts for all of these industry group ETFs that I follow. And one of my favorite ways is to look at these in the summary format. So if I click Summary, then I'm going to get a list, and it's going to show the performance. And what I can do here is I'm going to slide that over for you. And the period, I'm going to go to year to date. And there we can see the performance for everything year to date. I can click the top heading there for a sort. So now I'm sorting by the name. I can also go over and click percentage change to sort. And there I can get the leaders year to date. There we can see XES is up over 18% year to date, and clearly leading. We also have biotechs up 12 to 14%, regional banks leading year to date. And if I go down to the bottom, I can see the laggards year to date, gold miners, silver miners, semiconductors as well. Now, what I'm interested in, and before I show you that, just watch this. I'm going to go to 6 months. So let's look at the 6-month leaders. We've only got two that are up over the last 6 months, medical devices and mortgage REITs. And if you look at the 6-month rate of change, the losers are oil and gas over the last 6 months, even with the big rally. Biotech losing over the last 6 months, even with the big rally. So longer term, things aren't looking as rosy as they are year to date. But what I'm mostly interested in is 1 week, not because I'm necessarily a short-term trader, but I'm just looking for some signs of what is happening over the past week, because we've seen a breakout in SPY and a rally in the finance-related stocks. And there you can see broker-dealers and banks are leading over the past week. But if I click this to reverse the sort, to put the ones with the biggest declines at the top, there we can see home construction is lagging with one of the bigger declines. Retail is not up and not participating. And the SOX, the semiconductor ETF, is not participating. And those are three key groups, especially retail and semis, because they haven't been that strong over the past few weeks. So let's look at those charts. So here's a chart of ITB, and it had one heck of a rebound here after hitting a 52-week low there at the end of December. And then it did break above resistance here, but I'm still a bit hesitant to call the trend up here because, it's well below the falling 200-day moving average, which is way up there at 36. And then it started to weaken over the last 5 days. So at the very least, maybe it's going to pull back. So, if you're interested in housing, maybe if we get back to the 30.5 area, that might be an opportunity. But I still think the longer term trend is down here for housing. And then if we look at retail here, which is one of the most important groups because it is an economically sensitive group here, we can see the 61.8% retracement, the 50%. So we're in this zone, the falling 50-day moving average. So we had a huge move down to a new low. And now we've had a counter trend bounce, and we may be turning down here. We got a 30-minute chart coming up. And then here's the semiconductor ETF SOX here, and we can see it's well below the 200-day there. It had a breakdown and then a bounce, and it looks like this bounce may be rolling over even though it got above its 200-day moving average. So again, looking at this 30-minute chart for the semiconductor ETF SOX, there we can see that gap down. And after the gap, we consolidated for a little bit and then moved lower yesterday and broke below that little consolidation support level. And again, I wouldn't be sweating this short-term negative stuff if it weren't for what I think is a bigger downtrend at work. Then if we look at the retail ETF XRT, we can see a similar thing happen. It actually broke down well before the SOX. There you can see that big gap down. And then we had a rising wedge, and we broke the wedge, and we flattened out a little bit, but haven't turned up. And retail has been lagging for over a week now, so it may continue lower, and that would weigh on the consumer discretionary sector. Now we're going to turn to the intermarket arena with bonds, gold, silver, and the dollar. So first of all, we have the unadjusted Treasury bond ETF, IEF, the 7 to 10 year. And I preceded the symbol with an underscore there at the top left, and that removes the dividends and the distribution, so you just see price action. But what we see on this chart here is a clear big move with, a break above first resistance, a break above the 200-day, and a break above a major resistance level. We kind of got overbought there in early January and pulled back. Now we've been firming a little bit, and I'm watching to see if we get a breakout here in Treasury. So if Treasuries start moving higher, that would of course suggest that Treasury yields are going to move lower. So we want to watch out for that. And if money starts moving into bonds, they're a safe haven, and that could weigh on equities. We look at TLT, a bit of a different picture than what we're seeing at the middle of the curve. TLT is, of course, at the longer end of the curve with 20-plus year Treasury bonds. But what we see here is this pullback, and it's too steep for trend line, so I drew a Roth regression channel. And basically, we break above 121, that would end the pullback. And you can see we're above the 200-day there. So I think the bigger trend is up here. The bigger trend bias is up. And if we look at the 30-year yield, kind of a rising wedge, and watching to see if we get a break there. Now, gold has gone nowhere the last week and a half or so. It remains in a tight consolidation, so just kind of watching those boundaries, if you will. If we break support here, that's going to be negative. I think the dollar is turning up, so that could give way to a support break in gold. But gold seems to be attracting money as an alternative to the volatility we've had recently. So we'll see if volatility settles down, gold could pull back. But it probably depends on the dollar, and it looks like the dollar did turn up here over the last few weeks, and I think the bigger trend is up. So this was basically a correction, and I think this correction is ending now for the dollar. If we look at silver, we have what's called a high and tight flag. And these patterns, they look so good when you see them, but often they result in whipsaws. So they're tougher to trade than they look. But silver, for its credit, has a breakout there and a break above the 200-day, and then this flat flag. So you have a big surge, a flat, tight consolidation, and technically you get a breakout. That signals a continuation lower, but it's probably going to depend on what happens to gold and the dollar. And speaking of the greenback here, there you can see the UBUP, the dollar ETF. Clearly the long-term trend is up. All right, we had that little correction there with the wedge and then the wedge breakout. And now we've got another correction. It's a sloppy channel. Yeah, I drew through this spike low, but I think it's a correction within a bigger uptrend. I mean, that's pretty much all I'm trying to do on a chart. What's the bigger trend? All right, if the bigger trend is up, then I deem this pullback, this decline, to be a pullback correction within that trend. And so I'm looking for a continuation signal, and the dollar had that inside day there, and then it turned up. So if it breaks back above the 50-day, that would argue for higher prices in the dollar, and that could weigh on gold. And now let's finish with some stocks to watch, and most of these are bearish setups. All right, so here's some charts. I've shown Chevron before, and I think it's a bearish setup because, first of all, the bigger trend is down. You have a support break there, and that zone is turning into resistance, and you hit it and started pulling back the last few days. Earnings are going to be on February 1st, which is in about a week, but this one looks like it's ready to continue lower. MMM is one of the weaker stocks over the last few weeks. We can see the pink line there is the 255-day price channel, and that's the 255-day low. So when you move below it, that's a 52-week low, as we had in October and in December. The middle line is the distance between the 255-day high and low, and we can't see the upper line because the 255-day high is way up there. And 255 days is basically 1 year, so I can see when something is making a yearly high or yearly low. But, this is a bearish-looking chart. You have a rising wedge, and then it looks like we broke the wedge line this past week. If you break back above 196, then you have to reevaluate here. Earnings are going to be in about 2 weeks. Google, now this is one to watch for the broader market because, if the market is going to get its mojo back overall, you need to get a break above the 200-day and above that that November, December high there. And if we can do that, then this rally is showing some serious oomph. But if you take a weekly chart of Google, there's a lot of support around 1,000. So we're getting a bounce off that level. Could be a rising wedge, and you have to watch support there because if you break that support, that's going to be negative for Google and the rest of the market. Next up is Intel, and Intel is, of course, very important to the semiconductor group. Earnings are going to be on January 24th in about a week. But what we got is a big resistance zone. There's the October high, the November high, the December failed breakout. There was a flag forming here, and we broke out but failed miserably. And now we're challenging resistance again. So Intel needs to get a breakout at 50 to revive the semiconductor group. Qualcomm is one of the weaker looking charts out there. You can see the big decline that we had here, a consolidation, and that's a continuation pattern because you expect to move in the direction of the previous move, which was down. So we're coming down. If we break support, that signals a continuation lower. And you can see here that earnings are going to be on January 30th in about 2 weeks. Coke is just consolidating with a triangle, so I'm watching for the direction of the break. Break up would be bullish, break down would be bearish. Earnings are on February 15th. And Pepsi shows the same thing and also has earnings on February 15th. There's that consolidation to watch for the direction of the break. Moving on to the next page, we've got Pfizer, which is firming up. Earnings in about 2 weeks. 52-week high right there. It looked like it broke support, but it rallied back. And now we're kind of consolidating here. And if we can get a breakout there around 43 and change, that would be bullish. Earnings there are on the 29th of January. And finally, Acuity Brands from the housing group has a bear flag, and it looks like it's breaking that flag line, and below it's falling 200-day. All right, so that concludes On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.